Hello friends, Namaskar. I am Anil Kumar Srivastav and I shall today present before you a new topic that is related with the economy of India. The present economy or economic factors are decided by the MPC, which are especially related with the repo rate or the bank rate or the other such factors which are related with the expansion of the credit and dearness, etc. And these are related also with the expansion and reduction of the availability of the cash. They are also decided by the bank rate, SLR rate and CRR rate. But it is now going to change. How it will change? On 21st September, what has happened? That is, the government securities are going to decide the total Indian financial market now. So this is a big change which is going to happen. Let us see how it will happen and how it happened also. On 21st September, it was declared by the JPMorgan Bank of JPMorgan Chase Bank of America that now the growing economies the importance of the government bond indices emerging market global diversified indices will play an important role. Global diversified indices will play an important role in the growing economies, and the growing economies consist of the 20 countries, 2 from the Africa, Egypt and South Africa, and 6 from the Asia, that is Philippines, Malaysia, Indonesia, Thailand, China and Turkey, and 5 from the Europe, namely Poland, Czech Republic, Serbia, Bulgaria, Hungary and Romania, and then the 5 countries from the Latin American countries, that is Brazil, Peru and what we call Uruguay, Chile, Colombia, and the North American countries of Mexico and Dominican Republic. These countries are called the growing economies, where the investment is most needed and the investment inflow is very high. So when on the 21st September, the JPMorgan Chase has declared that the global market, that the global diversified index, emerging market global diversified index will play an important role in investment. So on that day, the government securities of India, which has a 10-year maturity period, has came down its profit came down to 7.08, 2 years least, and later on it records 7.12. So this great event had happened, that is the JPMorgan new global diversified index, emerging market index, has a greater value to play for the for incoming of the foreign direct investment, etc. So India has at present 23 kind of GSEC government securities which are costing $236 billion, and these have a 2.5 year maturity period. That is, the maturity period will be uh, will only end on 31st December 2026. And so if when India is going to join this this index, that is GBI, emerging market, GD, by 2024, then in the 10 years, in the 10 months, in every month there will be 1% profit, and there will be 1% flow, and in the 10 months there will be a flow of $25 billion investment in India through the debtors who take debt from these agencies in the form of the GSEC agencies, GSEC securities, government securities. That is to say that if India is included in this list, then the $236 million which are to be matured by 31st December 2026, and India is going to enter into April 2024, and if we see by March 2026 in the financial year, next financial year, it will be nearly a flow of $25 billion investment, and this investment will be needed and will be needed by the private investment makers, and private investment maker from India will use or take debt for the investment, and $25 billion will be invested in the form of the international foreign investment. And GSAC and the JPMorgan companies or JPMorgan indices have this peculiarity in this, that there is a availability of the debt to all private owners and private lenders who are going to invest, and there is no local restriction of any country on this type of securities. So there will be a more and more flow of the funds from the international market. Nearly $40 billion will flow in one financial year in the next year. So what we are going to say is that when the private investor wants to invest money, he will invest from this group of money, from this GSEC, government security money, and when it is included, so it will be nearly $40 billion. So India is already the part of the GBI bond and GBI emerging market, broad diversified, but not it is a part of the global diversified. Broad diversified, it is already a part, and nearly 73% of the GSEC owners in the JPMorgan have already told that the government, since the Indian economy is growing very fast, and it should be included in this, that is in this indices that is called emerging market global diversified indices. So we are going to enter into this. What will happen later on? So later on, the private investors will take their investment, take the loan from these banks, these government securities, and now the private investors will not go for the investment to the local banks, and there will be no ups and downs in the local banks for the for the investment. And in this way, the pressure on the national banks will come down. And and besides this, the demand for the demand by the private sector investors will go to the jpmorgan global diversified market, and they will take loan from there, and so the quantum of the debt from the national banks will decrease. And here there is a new regime that will come to play in the Indian economic market. That is, there will be no pressure on the Reserve Bank of India, that is Central Bank of India, for the controlling of the credit. That is, because the private owners will go to take loan for the investment to the emerging market, diversified global market, and so the pressure will reduce. And if the pressure is reduces on the local market, what will happen? The Reserve Bank of India in its monetary policy will find no pressure from the local investors, and that is why there is hardly any need of controlling the money, and there will be less pressure on decreasing or increasing the repo rate or reverse repo rate, and there will be less pressure on the bank rate and the inflation and the deficit financing, because these all concepts, whether it is deficit financing or whether it is the bank rate or whether it is the repo rate or inflation rate or the dearness rate, all are interrelated, and these there will be no problem in handling these issues by the central bank, that is the government, that is the Reserve Bank of India. So in this way, we find that when we are going to enter into this emerging market diversified, global diversified indices, then the whole internal economy will automatically, pressure will be down, and the local investors will resort for the debt from that emerging market diversified indices, and in this way India can almost get $40 billion as the investment that will flow in the Indian market. And besides this, the Indian economy will be more and more stabilized, and because of this, the other financial companies, India will also enter into Russell and the FTSE, and there the more and more, nearly 10 and 12 billion inflow of the fund will come through these agencies. And the rating agencies, the financial rating agencies like Fitch and S&P and the Moody will overrate our rating, overrate our investment, our economy, and that is why there is a all-round benefit. On the one hand, our economy will be more and more stabilized, more and more funds will come into India, and there will be no pressure on the Central Bank of India for controlling or reversing sometimes in the repo rate or the inflation. These will all, and the deficit financing, these all will be controlled. And besides this, the one thing that will also come out as an important factor, that is the Indian economy will be treated as the most advanced economy of the world as far as the credit, as far as the availability of the capital is concerned. So in this way, the stature of India will go up, and this will increase our goodwill in the international arena. Thank you very much.